Welcome, ladies and gentlemen, PDAC 2018, and we are now at the booth of Uranium Energy Corporation. And with me here is a very well-known and well-respected guy. His name is Scott Melbye. He's the Executive Vice President of the company, but also he's a real expert for the uranium markets. Scott, welcome.
Welcome, Johan. It's great to always visit with you, whether it's over in Europe or here at PDAC in Toronto.
That's right. Thank you very much for giving us the time to do an interview because, as I said, you are really well-respected expert on uranium markets. And I think for our viewers, it's really, and also for myself, very interesting. What are your thoughts on the market and why this price has not turned higher?
Sure.
Because production goes down.
Sure. I think for any investor in the space, and certainly the companies in the space, it's very much tried our patience, this very long and slow recovery that we've seen essentially 6-7 years of very difficult price conditions in the market. But the economists and all of us know that that's the solution for low prices is low prices.
Yeah.
And I think the news out of 2017 was very encouraging in that we really turned the corner in terms of the fundamentals. And by that I mean the production levels. We, despite falling prices year over year, we continued to see global uranium production increase, and in fact reached a peak in 2016 of 162 million pounds produced globally around the world in 2016.
And what was consumption?
Consumption now is running about 188 million.
That's already a deficit.
So we've been in deficit in this industry for many, many years, so we've been drawing off secondary sources. Well, this year we expect production to be falling close to 140 million or lower. Production was at 151 million pounds last year. So we're finally seeing that shoe drop, which is the production response to low prices. The reason it hasn't happened sooner is that our industry is characterized by a lot of hedged long-term contracts. So producers with much higher production costs were not shutting in production because they were still enjoying prices under old contracts. But that's now
that comes
ending.
to an end, right?
We're in the peak of that, the bell curve of these contracts falling off. We're probably in the peak of that right now. It's been occurring for the last 2 years, and probably by 2020, you'll see most of these higher priced hedged agreements fall off, and there will also go the protection for some of the higher cost supply.
Wouldn't it be like a normal, let's say, economic reaction of a buyer of uranium that he says, wow, now it's so cheap, maybe now I should do a 10-year contract, or even, let's say, a 5-year contract, right?
Yeah, well, this is the next shoe to drop, is that we've seen the fundamentals turn the corner in 2017, but we haven't seen the spot price increase much. It's up slightly, 20-25% off of its lows, but we haven't really seen the market tested by the renewed utility procurement cycles. And we have to remember that some of the biggest cuts that we saw from Cameco with McArthur River and the Kazakh reduction in production going forward, that happened in November, December of last year. So we're still very early in that phase. But the utilities, when they come to the market and they have very significant, perhaps as much as 750 million pounds of uncommitted demand over the next 10 years, every month they delay, they're getting 1 month closer to their significant needs. And a couple of reasons, we are seeing a pickup of non-US utilities. The Koreans, the Brazilians have been in the market in the last 2 weeks, but the US utilities are notably absent. And it's for an interesting reason, and it's really following, and it's very timely, with the steel and aluminum tariffs being announced in the United States last week. There is also a similar Section 232 petition in front of the U.S. Commerce Department in the U.S. for uranium and dealing with foreign uranium imports. So the utilities now, while they should be coming to the market, are probably waiting to see how the Trump administration comes down on that. Now, of course, that would be very good news for UEC as one of the major U.S. players, and with our assets in Wyoming and Texas.
Yeah, absolutely, because you have a full production facility, you're doing the ISR, but the thing is, you can be like in whatever, 2-3 months back in production, right?
Yes, we have.
It's only kind of maintenance.
Yeah, I mean, we're in production, not in production now, not because we can't. We've chosen to shut in, which was the right choice. As an unhedged producer, we would just be wasting the asset, and it wouldn't be in the shareholders' interest to blow out our world-class assets in South Texas into a crummy market.
Exactly.
So what we do is we continue to license, permit, doing drilling, very focused drilling to increase our resource base, but as you said, be ready to produce within 2 or 3 months from Palangana, but also getting the wheels turning on projects like Burke Hollow, and even moving into Wyoming in the Powder River Basin, which is our most recent acquisition.
That's right, and I mean, last year was quite successful for you guys. First of all, permitting is on the one hand, but on the other hand, you really raised the resource significantly, right?
I mean, we're a company now that has 100 million pounds in the ground globally, and that's our vision, that's our strategy, is embrace the market downturns. In the commodity business, it's inevitable. You're going to have the peaks and valleys, but instead of just sitting on our hands during the valley, the difficult times, we've been out acquiring assets and increasing both organically within our existing deposits and also going out and acquiring Reno Creek and North Reno Creek, which is the latest deal to close with Energy Fuels, where we now have a 22 million pound, 2 million pound a year permitted foothold in the Powder River Basin. And we're very, we love Texas, we love the regulatory and resource culture there, but Wyoming is the other state in the union that is really favorable for mining in general, and specifically with uranium.
Super, perfect. Maybe a little bit tricky question, but I like to pose it. You mustn't answer if you cannot, but what do you need for UEC to restart? Let's assume a utility would come to you and say, hey, you know what, guys? We would guarantee you £1 million per year for the next 5 years at whatever, $65.
Right. Well, we've been quite open about that. Our assets in Texas, we would feel comfortable restarting in a $40 plus uranium market. Wyoming...
That's spot price then.
That's the spot price. Yeah. And we would still be a little reticent to lock into long-term contracts because we do want to remain unhedged. It's a very important strategy for our shareholders that we not cap the upside for them. We would rather keep that uncontracted and sell it into the spot market at the time we produce it, or sign market-related long-term contracts with utilities. Either are certainly doable. So, yeah, that $40 to $45 market, which is not that far from where we are today at $22, $23 a pound.
It's only a double.
But we're from such a low point. And I think in last year when we spoke at various locations, we said that it was inevitable that production cuts would have to happen at $20 a pound. No producer really can make money.
Nobody makes money,
And so now, since that time, in the last 12 months, certainly the last 24 months, we've seen significant global production cuts, and that's a very important catalyst.
Yeah, perfect. Well, Scott, thank you very much on that.
Great.
And let's keep fingers crossed that the buyers wake up and finally do something.
They have to surface for air sometimes, so we're very excited about 2018 is going to be a very good year.
Super.
Thank you,
okay,
Jan.
I love that. Thank you very much, Scott.
Bye.
Yeah, ladies and gentlemen, it was Scott Melbye, the Executive Vice President of Uranium Energy Corporation. And you heard it, he is bullish on uranium, as we are, of course. We expected it already for last year's third, fourth quarter that really something is moving on the price here. But anyway, the markets have their own soul and their own behavior, I would call it. But still, the market is really going into the direction. It is a strong deficit. The demand is going on and going up, of course. And the Japanese are putting on their reactors again on stream. So there is uranium used. Much more uranium used, and I would say UEC is in the right spot here in Texas. And if the markets really start, as Scott said, $40 to $45 they need for a really successful and good marginable production, they are in, let's say, 2, 3, 4 months maybe back in the game, because everything is there and everything is set up. And while they wait, they do their homework. That's exactly what we want to see. So check it out. Thanks for watching us. Bye bye from PDAC Toronto.